Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for about the next 20 minutes here on Options Guide TV. The first trade that we have to do, the first thing at hand, is to talk about the Chewy trade that we did going into earnings. Earnings was this morning. I was thinking it was after the close, but we already got the detail on it. Chewy was weak going into earnings, and then today we're seeing it down about $5, right around the expected move. Well, a little bit more. I think the expected move was around $4.30, and we're showing it down 5 at this point in time. So here's the parabolic chart and the parabolic move, and I'll zoom out here and kind of show we're at a very interesting point as far as Chewy is concerned, in that we are I'm going to show you the most recent action and we'll zoom in on it. But right at this 40 level, there's a lot of noise in the chart. Look at how congested the area is going all the way back. Here, we bumped up against that high and then had the retracement here, came all the way up here, came close to the 40 level once again. Actually, at 40, I think the high on that day was $40.13. I think that's where it was at. And now that's where we're at as we speak. We're sitting right at that level. So we put together an open wing butterfly, so we might as well take that position off if we would like and close that out. But it's interesting in that we have a potential to even get more short on the Chewy situation. We still have a ginormous, well, here's the PE. The PE inside the Tradier Pro platform is 186. The forward PE, based off of, anticipation of earnings and everything that goes along after the report, is right around 78 times earnings. So even on a forward PE basis, this stock is a little bit overblown. Now, as far as, retail, this is good news that they've had this type of movement to the upside. I just don't think that it can be maintained, and it's going to have to give a little bit back. And that 40 level is very interesting. So at this point in time, I would close out our butterfly that we put together, and then just think about maybe next week if we get a confirmation below the 40 level. Well, heck, maybe we do it on Friday. Who knows? But if we get a confirmation below the 40 level, I do think that there is some continued downside. So let's zoom in a little bit now on the actual trading. So I'm going to grab the graphic and we're going to slide from here. And we'll see that. Let me do this so it's out of the way. Here's where the 40 level is at. And this is, we've obviously made a strong breakdown through the 20-day, and that, that's noise a little bit, but here's where the 50-day is at. And if we break through that, then you're looking at the 200-day. Just by looking at moving averages, we could see some weakness down to around the 35 level. Now, implied volatility is going to come in a little bit. We are down. It's not like it dropped ridiculously like it normally would if the stock went up, right? But the stock is down today, and because of that, we could buy some puts, and I could see just buying puts outright and maybe rolling into a long put spread. But we'll have to wait. We'll have to wait to see if we do get the confirmation down below the 40 level. This is exactly where that high is at. Yeah, if my crosshairs are correct, we're talking about $40.24. So we would like a solid breakdown to this level, 39.5, 40. If we can close at that level today, that would be a very bearish move as far as Chewy is concerned, and I think may lead to some more downside momentum in the underlying stock. Now, we put the trade together in Chewy, and I guess I'll run over to the trading tab. We bought 6 and sold 2 of the 43 strike puts and bought 1 of the 41.5 strike put. Stock was just above 46 at the time. We did the shorter term expiration, which was the June 13th expiration. The maximum, if we take a quick peek at the what if calculator, We knew that if the market went below our short strike, because of the way that we set this trade up, that it would trade for at least $1.50 below 41.50. Below 41.50, it would trade for that at least. And we put it on for 76 cents, or we'll call it 75. So we put it on for 75 cents. And the max, we knew that if we blew through the strikes to the downside, we could probably sell the butterfly for 150, and hence we would get out and make 50 cents. So this is where the open wing butterfly gets interesting. No problem just closing it right now. As a matter of fact, you can get more than 150 for it. It's trading at the midpoint at $1.83. So it would be more than a double on this trade that we put together. But there's not a lot of risk at this point in time. Now, realize that this is as of today based off of this price, and that's why we currently are below the zero line if the stock were to go below 41.50. But if we look at it relative to when we first put on the trade, it would have been up in this range, and the maximum would have been about 75 cents, right up in this range. So with that mentioned, you could stay in this. Now, it's really all about how close are you going to be to your computer if the stock does come back within the range. You don't want the stock to go through your strike. If it hits 43, you want to get out no matter what. But every day that goes away, you know you're locked in below 41.50, that you're going to get somewhere close to 150. Well, right now, now it's 167, but at that moment it was 182. But if it comes back in this range, it could trade for as much as $3 on this at this precipice at the 43 level. So okay with you hanging around. That's simple. Okay with you seeing if you can get the market to come back towards the 43 level. But don't let the stock get away from you. Don't let it, if it bounces back and starts going all the way to the side, if it hits 43, get out. No matter what the price is, get out. It's better if it hits 43 on Friday than if it does it on Thursday. But I also close the trade. You know, it's 188, couple of day trade, more than doubled on the trade. Obviously, a very easy win in this scenario. So if you have any questions about the trade, we do got that chat box opened up. Feel free, whatever platform you're on, chat away. Love to make this a more open discussion about these trades. And, you know, in hindsight, maybe a flat out call spread or bear put spread would have rewarded you more. But you always have this little middle area if you do it. This is, to me, this trade is an alternative to a bear put spread or a put debit spread. It gives you more reward if you get kind of the move, but if you get the bigger move to the downside, the bear put spread is going to reward you more overall. All right. Also, the initial risk is lower. And I guess that's a real important point. The fact that you're selling two of these option contracts that are fairly close to where the underlying stock is at when we put it together, they're just a little bit out of the money, will reduce the overall cost of getting into trade, which means you have a little bit less risk if you are incorrect on the trade. Bottom line is I like this. I like this as an alternative to just doing the boring put debit spread or call debit spread. Okay. Now I'm going to go off the grid here a little bit. And it's just something that I kind of saw in the crude oil chart that we might be having a little bit of a breakout to the upside in crude oil. And I'm going to use the USO to place a trade. So not, we're veering away from the SPX this week. Earnings season is coming to an end. I did find the good, I obviously, as I mentioned on the show on Monday, I'd like the Chewy trade. I put the trade on in my own account. I was a little bit wider. I went 4 points wide, and I'm trying to get out of that trade right now for around $3. but I haven't closed out the trade yet. I haven't at this moment. I think I paid $1 for it as opposed to 75 cents. That was on the trade, but I waited till closer to earnings and placed the trade at that point in time. But the market, slowly if you throw in the fact that just the entire week the stock was down and now it's down even more, the 40 level is going to be very interesting if the stock holds this level right now, and it's also set up for a potential bounce. That level obviously can work as support on the downside, and maybe you get the bounce here and you go back and you land right at the 43 level. Who knows? But that 40 level is very important. If it holds, it's bullish. If it breaks, it's bearish. Quite simple. Let's go in and look at the USO. Thank you, Anthony. I appreciate that. Anthony, go ahead and toss that up there. Anthony had a nice little comment. All right. Anthony, did you actually do the butterfly? Or did you adjust it at all? And so I'm going to look at the USO. We're getting a little bit of a confirmation. If we look, I'll pull up the chart. Crude oil would be a better chart to look at. USO doesn't always track exactly crude oil, but it's a very liquid marketplace. So I like trading in the USO. And here is let me zoom out again. Okay. So this is the breakout on the 200-day moving average. I got a 1,000-day chart here that we're looking at. And a decent breakout in this new high. Now, this gap all the way up here, I think is potential. I think we got potential to get back to this level as far as USO is concerned. Crude oil is trading right around $66 a barrel. Not a bad price, and a lot of people do think that it could go lower. That's been the fodder. But I do like what I'm seeing on the action in the chart here, and so I want to do a trade where I'm just going to sell a put spread. Now, if I do get a little bit better confirmation, I might actually take some of that and buy a long call. So I'm going to get fairly bullish on the USO right now. So I'm going to start by selling the put. And then if we come back on Friday and we like what we see, okay, Anthony did the open wing. Go ahead and toss that out there. So that's awesome. He did the open wing butterfly. Nice. Yeah, and I think I think we've coined a new name for a trade. It's not as good as the fig leaf as opposed to the leverage covered call, and the fig leaf is the name for the leverage covered call, otherwise known as a poor man's covered call. But I think open wing butterfly, this really describes this trade. I hate names that don't make sense. Broken wing butterfly. I guess the graph looks like it, but it doesn't tell you much about the trade and what you're doing. Skip strike is better. Okay, so I digress. We're in this trade. Here's what we're going to end up doing. We're going to sell an at the money put spread, and we're going to go out about 30 days because we want some time for this to play out. We're trading at about a 32% implied volatility. We're a little bit higher than the average volatility. So we like this. We like this situation. We're going to try to generate some decent amount of capital. In other words, I'm going to go fairly wide on this trade, and I'm going to take on some risk. I'm going to hope that the 200-day does actually provide some support in this underlying, and we also get that inside the crude oil chart, and then that gives us some potential to use that premium to possibly buy an out of the money call somewhere around the one standard deviation move. Delta on this one's 41.36. So you'd look at 76 is $1.49. That's not bad. I don't know why there's not a 77. That's kind of annoying. I'd like to maybe buy a 77 or 78. I don't know if I want to go all the way out to the 80. That's at a 20 delta there. All right, but let's get the first part of the trade done. Here we go. Let's clear this out. We're going to sell the 72 strike, and then we're going to go down about 10 points and buy the 62 strike. So in this instance, we're going to bring in a decent amount of premium. So here's the one that we're selling. that we hope holds. And I'm froze a little bit. And then we're going to go all the way down. 62 is 19 cents. Yeah, we can spend a little bit more. Let's do, this would be enough to help pay for our option contract. We'll do the 65 and we'll buy that. All right. So net credit to the account, $1.62. And I'm literally looking at this as, okay, $1.62. Well, I could buy the 76 strike call. If it holds, if we get a little bit of momentum to the upside. Right now, that's trading right about there. I wish there was I'm kind of surprised. I wouldn't be surprised if they actually did open up a few more strikes in this underlying, but that's what my goal is. I'm hoping to make at least $1.62. I hope that as far as the chart is concerned, that we're holding here and we look to try to fill this gap, and the 200-day moving average actually matters in the USO in this scenario. And we're going to do a very simple 30-day trade in the USO that will look to adjust, and maybe we add a long call to that position. And Anthony, go ahead and toss out the last comment there. Yeah, the VIX trade, the VIX long call trade. I don't mind the VIX trade at all. And I would continue to. Did you close out the long VIX, Anthony, or are you out of the position? Because I am wondering if you closed that one out. But if I look at the VIX and going out in time, especially if you want to go out as far as September and October, I wasn't going to talk about like this. I wasn't going to necessarily look at it at this moment. Okay, you're out. Good time to resurrect it. Okay, so you're out, and you might have got out when we talked about it on the show. I think it was a few weeks back that we talked about closing it out when we got that little spike up. But I like buying these all day long. Let's see where the September future is at. How many days you got? 98 days. Yeah, you're going to be paying quite a bit for it going out 98 days. But let's see where the future, where the call and put line up, right around 21. So that's a little bit of premium to go out to September. As September approaches, if we get into July and the VIX is trading around 16 still, and this comes off a little bit, but remember, if you're looking at the VIX, they trade based off of the future. And so we look at put call parity to try to determine where the stock is at. Or you can go to the CBOE and go to their delayed futures quotes, and you can see where the VIX is at. I find it crazy that they don't provide the actual underlying quote for the VIX options. They used to. I actually asked them to do it when I was on the retail markets committee at the Chicago Board Option Exchange. And you used to type in VIX SEP and you used to get the an index that would track the future. And it doesn't work anymore. Okay, so here we are. So you scroll down to here, you buy this option contract and you sell this option contract, and you're going to come fairly close to even. Okay, come on. There we go. Of course, I did too. I got excited and I clicked on it twice. So that's about 7 cents. Okay, so that means that the call option is trading about what the put option is trading for. So if you just think about it logically, well, if they're both fairly close to equal, right, that means that's where the future's at. You're paying about the same amount for the put as you are for the call. Put call parity plays in a little bit, but we don't need to get into interest rates on a shorter term option contract. But with that said, we know the VIX is right around 21. So I don't know if I want to put that one on. Maybe September seasonality's in there. Let's look at the August one, though. We're 70 days away on August. 70 days away in August. And if we scroll up on this one, yeah, August is looking a little bit more interesting. It's not quite as inflated. It's at 20. Let's get rid of this. 239. Maybe it's closer to 20. It's somewhere, it's maybe 20 and a half. All right, let's buy the 20 there, and let's sell the 20 there. 48 cents. So yeah, it's $20 and it's a debit. So it's $20.48. That's where the future's at. Hmm. If it gets down to 18 or 19, I'd be very interested in that. So if we need another rally, Anthony. We need another rally. We need this future to come down below the 20 level before I want to buy it. The July expiration, the VIX futures at it looks like around 20. Buy this one. It's just shy of 20. Okay, here and sell this. Yeah, so it's 1958. $19.58 is where the July is at. But August and September last year in particular were extremely volatile months. Yeah, well, I'll think about August if we can get down towards the 19 level on the futures contract. Fair enough. All right, 10:25 Eastern time. Well, I'm in Chicago, so it's Chicago time, 11:26 Eastern. And I guess we'll call it a day. Anthony, thank you for participating in the chat. By the way, Anthony's not the only one that has access to the chat. You always have everybody has access out there. So please feel free to this an open discussion. If you have an underlying that you'd like me to look at, I'm happy to do so. I did like the Chewy trade, and I do think that one's still got a next stage to it. We're going to sell that put spread in the USO. Hopefully we get a little bit more momentum to the upside, and then we might take that credit and use it to try to buy an out of the money call option. We're going to look to get bullish going into the summer driving season on oil. And we're only going to go out 30 days. You know, I don't plan on sticking around the entire 30 days, but that's the option contracts that we're going to deal with. I'll be back in Charlotte, North Carolina on Friday, this coming up Friday for the next edition of Options Guy TV. I hope that you have set up your profile in the hub.tradier.com, access to all the great speakers that Tradier put together to try to help your education process as far as options are concerned. 11 a.m. Eastern time this Friday, and hope to see you in the hub.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.